The road ahead to reach the Fed's 2% target is starting to feel a little bit bumpy. Disinflation may be ahead, as well as potential bouts of volatility. So this leaves investors pondering where they should be looking for investment opportunities in this environment. We're going to get into all those details right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for being with us today. I want to get right into the conversation with my guest, Brendan Murphy. He is the head of fixed income at Insight Investment. Brendan, great to have you here. I read one of your recent market updates, and you call it a bump in the road to 2%. And here we're talking about the Fed's inflation target, which we'll get into here in a second. But by some reports, there's something like $6 trillion of cash that's sitting out there that investors are just holding and not investing. And you say that this is the wrong time to be in cash and the right time to be investing, especially in fixed income. Tell us what's behind that.
Yeah, and that's typically the number one question I get. There's a lot of people with cash on the sidelines, and they're questioning, trying to get that timing exactly right. And my advice is, think about the big picture. Think about, typically, if you think about these cycles, what happens is sometime between when the Fed's done hiking rates and when they begin their rate cutting cycle, that's typically the best time to get involved, to take more duration risk with your fixed income portfolio. Most people, when they think about fixed income, what are they looking for? They're looking for two things, I'd say. One is income, and the other is ballast. Mm-hmm. So what does that mean? Income is, you're earning some kind of yield. And given that the Fed raised rates as aggressively as they did, we're at a level now in yield terms where the yield looks quite attractive. Certainly unlike anything we've seen sort of in the post-GFC environment.
Yeah.
The other thing that they're looking for is ballast. And what do I mean by that? I mean, you want an asset that's going to act like a diversifier in a time when risky assets potentially come under pressure. Well, because the Fed raised rates to 5.5%, if we do enter a more challenging growth environment and the Fed needs to rapidly cut rates, that's where that duration is going to kick in your fixed income portfolio. So you're going to want that duration. That's something you get with bonds that you're not going to get with cash. Cash will give you the income, but you'll only get the income as long as the Fed keeps rates high. Once they start cutting, right, you're going to lose that income component. So right. My advice is don't be too cute. Think about the big picture. We're at historic levels that we haven't seen in a long time. Now's a good time to at least dip your toe in, if not go all the way into fixed income. Right,
exactly. I mean, certainly having a diversified portfolio is key. We believe that here wholeheartedly at UBS. But if you're somebody who's sitting in cash for the last 3 years and the direction that inflation has gone, your cash has lost value just sitting there by itself and not being invested into, as you said, we've seen some crazy returns on. Look at even the 10-year Treasury as we sit here today is at 4.3% after hitting 5% last October. So these are returns and yields that we haven't seen ever. Some of these are historic. Right. So let me just ask you, Brendan, because something that you talk about in the note is that you believe we're in a disinflationary period. And somebody might say, well, what is disinflation? And my definition would be inflation is when you're on the highway and you're picking up speed. Disinflation is not going backwards. It's just staying in the same direction but slowing the speed down. If you're in a car going from 50 miles an hour to 30 to 20, so given that you think we're in a disinflationary period right now, how do you think about allocating within fixed income assets? Because we do expect the Fed will start to lower rates perhaps this summer. I think that's what you also think.
Yep, we do. So we see the Fed cutting rates sometime during the summer. I think it's interesting to think about what this rate cutting cycle looks like, right? There's been tremendous volatility in fixed income markets around people trying to aggressively price in cuts and then taking them out, right? So I love that as an active manager, right? Mm-hmm. Because that's one way that we can add value is by sort of fading extremes when the market pricing gets too excessive. And we're in uncharted territory a little bit in terms of how rapidly the Fed raised rates, in 21 and 22. So, as we think about going forward, this disinflationary environment, if it's likely to persist, that's the best case scenario, I think, from a return standpoint. It's one where inflation can gradually move lower, and the Fed can gradually move lower to bring rates back more in line with what is historically normal. The alternative scenarios where inflation picks back up again, or where inflation falls like really aggressively and we get deflation, right? Those are the two tail risks around that. And the Fed's response is going to obviously be very different in both those scenarios. But again, that could be a source of volatility in markets going forward.
Right, and we keep looking out down the road, as you said, to the 2% inflation target, which, by the way, just historically, it's this number that was sort of made arbitrarily by the finance minister of New Zealand back in the late 80s in an interview on TV. And so other Fed governors and Fed Reserve chairs have picked up this 2% target, including Ben Bernanke when he did it 10, 12 years ago. So when we think about the Fed's target and you're looking at CPI, which is around 3.9%, what kind of returns can we expect in a fixed income portfolio these days? Obviously, there's no guarantee of what that will be, but given where we expect the Fed will eventually want to, what they'll want to do to get to that 2% target by cutting rates, what returns can we expect?
Yeah, so you start with the yield, right? So if you think about, well, first question is, where do fixed income returns come from, right? And sort of depends on how you're accessing and what type of vehicle you're using. But I think about it pretty simplistically. So you mentioned call 10-year treasuries around 4.25%, right? So that's your starting point. You got Fed funds is 5.5%. Treasuries, depending where you are, 4.25%. So that's a pretty good yield in and of itself. That's super high quality. You're not taking much risk to achieve that type of yield. You start introducing other sectors, whether it's investment-grade corporate bonds, U.S. agency mortgages, various parts of the asset-backed market, right? A lot of different credit risks that we can take in portfolios to enhance that yield, which could give you another 100 to 150 basis points just by taking investment-grade risk. If you want to go even deeper in terms of credit risk and do something like high yield, there you're going to get another 3 to 4% right on top of that. So it really depends how much risk the investor is willing to take within that fixed income allocation and how far they're willing to go out the spectrum. The last thing I'd note is, if you're thinking about active versus passive, right? So with passive, the numbers I just gave would stand. You throw an active where someone's trying to give you another 1 to 2% on top of that, right? So you add all that together, and even in a stable yield environment, even when the Fed's not cutting aggressively, you can still get something in the mid single digit to higher single digit type returns. That compares very attractively with what people typically want out of their equities, right?
That's right.
So that's why this is a little bit of an unusual time, given that compelling yield that we have in the fixed income space.
Do you think that there's opportunity outside of the U.S.? I mean, the U.S. is the biggest fixed income market in the world, and other central banks right now from other countries are in different places of what they're going to be doing given monetary policy. But is there opportunity outside the U.S. right now in fixed income?
Absolutely, and I'd say both in the emerging market space as well as the developed market space. So, if you think about the Fed, and granted, we think the Fed will start cutting in the middle of the year. They'll cut, and won't necessarily cut super aggressively, right? Because the economy is going to slow down. There'll be an orderly moderation. That's not necessarily the case everywhere, right? So there's other parts of the global economy, both in EM and DM space, where you could see more aggressive rate cutting come through. So, I use EM as an example where if you think about this cycle's been unusual, EM central banks were a little bit ahead of the curve, right? They were hiking rates before the developed market central banks were. And so it stands to reason in our view that they'll be cutting rates sooner than you get out of developed markets and potentially more aggressively. So on the EM side, we like countries like Brazil, South Africa, Mexico, Korea, all places where we like to take duration risk with our portfolio. And then on the EM side, similarly, I'd highlight some countries like Sweden, Australia, New Zealand, some of the countries where we think the market may not have enough priced in terms of rate cut expectations. So if you can, balance your exposure to central banks, right? It's always diversification is your friend.
That's right.
Right, and the more you can diversify out of the Fed and into other central banks, you introduce more potential gains from a fixed income perspective.
Right, and as you said, central banks around the world might be cutting more aggressively than even we are here, so the opportunities are looking different in different countries.
Absolutely, and that's why, again, active management helps in that sense, right?
Yeah.
Because we can rotate through those different opportunities to try to add value, try to add that 1 to 200 basis point extra, active premium.
Terrific. Brendan, I wish we had more time. Great conversation. I really appreciate you coming by. Good to see you.
Thank you.
Thank you very much, Brendan Murphy. Again, from Insight Investment is a BNY Mellon company, and we want to thank our partners at both Insight and BNY. For more information and to make sure you're getting all the latest views from UBS and our great partners, visit ubs.com/views. Also follow us on the various social media platforms, and don't forget to talk to your financial advisor if you have any questions based on this conversation today with Brendan. Until next time, I'm Anthony Pastore. Have a great rest of your day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.